Imagine buying a house the same way you buy Bitcoin. Fractional, fast, and global. No banks, no mountains of paperwork, no waiting months for an approval. Sounds crazy, right? Well, it's already happening. From Bitcoin-backed loans to tokenized properties that you can buy into with just a few $100s, crypto and blockchain are colliding with real estate in ways we never seen and never imagined before. But along with opportunity comes risk. Fraud cases are already surging, regulations are still unclear, and one bad hack could wipe out millions in investments overnight. In this video, I'm going to break down how crypto is starting to transform mortgages and property ownership, the risks you need to know about, and whether this could actually make homeownership more accessible at a time when traditional mortgage rates are still pretty high. For those of you who might be new to the channel, my name is Asher Benjamin. I'm a mortgage loan officer with Nexa Mortgage, the largest brokerage in America. I work with over 270 banks, which means I've seen just about every kind of loan product that you can imagine. But what's happening with crypto-backed loans and its tokenized real estate is different. It's pushing the industry in a whole new direction. My goal here isn't to hype it up or to scare you. It's to give you the facts in plain English so you can make informed decisions, whether you're a home buyer, an investor, or just kind of curious about where the market's headed. So if you want to stay ahead of the curve, hit that subscribe button. Let's dive in. So why is crypto suddenly showing up in housing conversation? A big part of it comes down to timing. Traditional mortgage rates are still high, affordability is stretched thin, buyers, especially young buyers, are looking for creative solutions. At the same time, Gen Z and millennials, they're already comfortable with digital assets. Many of them trust crypto wallets more than they trust banks. And if you've been buying Bitcoin or Ethereum for years, why not use it to leverage a home? And let's be real, the traditional real estate process is slow. Tons of paperwork, middlemen everywhere, fees stacked on fees. Crypto and blockchain promise speed, transparency, and access that cuts through all of that. So that's why we're starting to see crypto and tokenization enter the mortgage space now and not 10 years ago. Let's start with one of the hottest ideas, Bitcoin-backed loans. Here's how it worked. Instead of selling your Bitcoin to free up cash, you borrow against it. The Bitcoin acts as collateral, just like a house would in a traditional mortgage. The benefit? You keep your Bitcoin. If it goes up in value, you still get that upside, while also using it to fund a down payment or even outright purchase a property. Sounds great, right? But here's the catch, volatility. Bitcoin drops, your lender can issue a margin call, which means you have to come up with more collateral immediately or they would liquidate your holdings. So if you bought a house using Bitcoin collateral and the price drops 30% overnight, like we've seen multiple times in the past, you could be in serious trouble. Still, pilot programs are already out there. Miami and Austin have seen the first Bitcoin-backed mortgages. It's niche, it's risky, but it's real and it's here. Now let's talk about tokenization, because this one has the potential to be huge. Tokenization is basically splitting a property into digital shares, tokens, that investors can buy and sell. Think of it like this. Instead of needing $500,000 to buy a rental property, you could buy 1% of it for $5,000. That token represents fractional ownership, and you share in the rental income and property appreciation. This solves two pretty big problems. Real estate is normally illiquid. You can't just sell 10% of your house if you need cash. Tokenization changes that. It opens the door to investors globally. Someone in Europe can now own a piece of an apartment building in New York with just a few clicks. But here's the flip side. Regulation around this is murky. We've already seen fraud cases where shady platforms overpromised, ran token sales, and then they disappeared with investor money. And without strong oversight, tokenization could turn into the Wild West real fast. That said, the idea isn't science fiction. It's happening. Back in 2018, a condo in Manhattan was successfully tokenized. More recently, platforms have started experimenting with multifamily complexes and commercial buildings. It's still early days, but the foundation is being laid right now. Another piece of this puzzle is DeFi mortgages, decentralized finance using smart contracts. Instead of going through a bank, you borrow from a decentralized protocol, peer-to-peer. The loan terms are coded into a smart contract on the blockchain, which automatically enforces payments and conditions. The potential benefits? Faster approvals, lower fees, and no middlemen. Imagine closing on a loan in days instead of months. But the risk? They're massive. Hacks happen all the time in DeFi. Billions have been stolen from their supposedly secure smart contracts, and unlike traditional lender, there's no FDIC insurance. If the code gets exploited, your money's gone, no one to call, no one to sue. Now let's talk about the upside, because there's reason that this is gaining traction. Tokenization could make real estate accessible to people who never thought they could afford it. Imagine a 20-year-old buying $500 worth of rental property instead of stocks or crypto coins. That's building wealth in a whole new way. For global investors, it creates diversification. You can own slivers of property in Miami, London, Tokyo without ever stepping foot in them. And for buyers struggling with high rates, alternatives like crypto-backed lending or DeFi mortgages could eventually offer cheaper or more flexible ways to finance. So while the risks are very real, potential benefits are game-changing. But let's be clear, the space is not without danger. As I've mentioned, fraud cases around tokenized property platforms are increasing. Regulation is lagging far behind innovation. And crypto volatility is still a huge risk for collateral-based lending. If you jump in this right now, treat it as speculation, not as a replacement for traditional financing. You don't want your home, your roof over your head, depending on whether or not Bitcoin has a good month. So here's the bottom line. Crypto and tokenization aren't replacing traditional mortgages tomorrow, but they are reshaping the future of real estate. It's going to be faster, it's going to be more global, and in some ways, it might make ownership more accessible than ever before. But it's also risky, it's unregulated, and it's not for everyone. If you're curious about whether these innovations could play a role in your home ownership journey, or if you just want to know the safest financing options available right now for you, please reach out. I'd love to walk you through your choices. And don't forget to subscribe, because every week I'm breaking down the biggest shifts in mortgages, housing, and the economy, so you can make smart moves with confidence. Thanks for watching, and I'll see you in the next video.